Hello guys, hope you're doing well. Now, in this short video, I want to explain certain concepts relating to the preparation of financial statement in accordance with IFRS. So when we prepare financial statements, what do we need to do? We need to comply with the various requirements under IFRS, the standards that are applicable to us. For example, if you're an insurance entity, the IFRS 4, if you did a business combination, IFRS 3, if you consolidate, IFRS 10. So these are some specific requirements under IFRS. But I want to say that if somebody wants to read IFRS for the first time, for the new beginners, for the beginners, from where they will start, I want them to read the IAS 1 first, because IAS 1 is a sole standard which specifies what is the minimum requirement of a financial statement, minimum requirement under IFRS, that what IFRS needs at minimum should be there in the financial statements. As such, now there is no standard which deals with the structure. It does not provide any kind of a structure, but it specifies certain minimum requirements, the minimum thing that a financial statement should possess. So currently we are dealing with IAS 1. I will be preparing some short videos on IAS 1. It may be around 10 or 20 videos specifically dealing with multiple issues on IAS 1, because IAS 1 itself is very vast. I can say that IFRS in itself is very vast. But if you want to understand what an IAS is, so think about structure. So when we see a balance sheet like this, see a balance sheet like this, you see a non-current assets, current assets total, you comes around the equity, non-current liability, short-term liability or current liabilities, the total equities and liabilities. So do IFRS provide a structure for this? No. Do IFRS says the minimum requirement, like we need to show is a non-current classification, current classification, we need to show this as a separate item, this as a separate item? Yes. So this is the requirement under IAS 1. So when you read the objective, so IAS 1 primarily applies to the financial statement, which are primarily called the general purpose financial statements. Whenever you read financial statement, it should be like a general purpose financial statement. So what do you mean by this? So general purpose financial statement prepared for those users who cannot demand a separate financial statement tailored according to their needs. A bank might require a financial statement to be prepared like, I want the financial statement on a liquidity basis, or I want to prepare something else. I don't want this. So they can tailor based upon their requirement depending upon the influence that you have in the entity. But if you're preparing for the public, for the general as a whole, so that financial statement is called the general purpose financial statement, and IAS 1 is applicable for the general purpose financial statement. So it's a very general standard. You cannot say that if a bank wants a separate financial statement, they need to comply by IAS 1. No, IAS 1 only deals with the general purpose financial statements, and one exception is there. IAS 1 does not deals with any condensed financial statement that you prepare under IAS 34, which deals with interim financial reporting. So this is the sole exceptions for that. And let me very clear to you, there is something called individual financial statement, there is something called separate financial statement, and there is something called consolidated financial statement. So I can say that I'll give you a brief example of this. Go ahead. You have something called individual financial statements. What does that mean? It means you prepare a standalone financial statement. I can say that when you prepare there's one category under this is called separate financial statement, which is dealt by IAS 27, which means that you have a subsidiary and you have a subsidiary or you have a joint venture, and you're just either measuring it at cost or fair value or an equity accounting method, which means that you are not consolidating them. You are just mentioning them as a separate separate assets, or you're just mentioning them at at your own values rather than consolidating them or applying the equity method in order to comply with any consolidated financial statements. And another one is the normal, without any holdings, without any investment in subsidiaries, investment in joint ventures, and invest any just financial instruments that you have, and you do not need to consolidate. So these are primarily called the individual financial statements. So IAS 1, the preparation of financial statements, is applicable for both the individual financial statement as well as for the consolidated financial statements. So here a doubt might arise, like what's the role of IFRS 10 then? And what's the role of IFRS 3 then? I don't want to complicate the situations. It's very, very simple. IFRS 3 deals and only deals on a nutshell, if I can explain it, deals with a calculation of goodwill and any intangible asset that you can get from business combinations. So in my point of view, whenever you are reading an paper like IFRS 3, you should have in your back of your mind that you're just thinking about the calculation of goodwill. But when you are reading standard like IFRS 10, it deals with the consolidation requirement. How you gonna consolidate, and who is going to prepare a consolidated financial? Do it require to be prepared by all of them, all of the entities, without having any holdings, or it specifies what's controls, what's the three conditions of controls, what's variable returns, and how power is there, how to execute the powers. So these are under IFRS 10. One need to focus on these areas. But at the end, but the most important thing is that this is the most important thing. Their financial statement should be prepared as the minimum requirement under IAS 1, guys. Hope this is clear. If you're not clear, just mention in the comments. I will do my best to clear your doubts. So now think about what is in financial statements. I'm going to talk about the contents, but what is a financial statement? IAS 1 primarily describes the financial statement as a structural representation, representations, which primarily deals with the financial position and financial performance of an entity, because we are not saying only profit and loss of the entity or the finance or anything else, because the term is broader under IFRS. Under IFRS, there's something called total comprehensive income, which comprises of two parts, the profit and loss that you earn from business, and something called the other comprehensive income. What is the definition of other comprehensive income? I'm sorry, I don't know, but I can give you one simple hint. Other comprehensive income are only the price movements in specific assets. That's it. If you go to apply hedge accounting, I'm not going to discuss it over here, but I know hedge accounting, but I'm not going to discuss it here because it will complicate the situation very much. So on a nutshell basis, total comprehensive income comprises of the profit that you have earned plus the other comprehensive income. So what is other comprehensive income? Other comprehensive income are just the price movements or the fair value movements in certain assets. Price movement can be termed as your currency movements as well, because the foreign currency movements in your foreign subsidiaries and operations, it acts as a withholding profit, and once the conditions are specified, some of them are transferred to P&L, which is why we call it the recyclable profit, and some of them will just transfer directly to the equity without any movements through the profit loss account. This is called recycled to profit. This is called non-recyclable to the profit, and you need to show it differently. I'll cover it in the next video, I promise you that, in detail. So what is a financial statement? Financial statement is a structural representation of the financial position and the financial position of a financial performance of an entity. And now guys, think, the IAS 1 specifically says that an organization or an entity need to specify the assets that he owned, the liability that you have incurred to get these assets, and the residual balance, I can say that is the equity of the entity. Now this is only the part, this is disclosed by the balance sheet or the statement of financial position in order to explain them the incomes and expenses including gains. Look, I can say that I want to clear one doubt. income in itself is a very broader term which includes revenue. Revenue includes both IFRS 15's revenue and other revenues plus your gains. These are primarily recurring in nature, these are primarily non-recurring in nature. These two things you need to understand, because income is a broader term. Revenue and gains are a subset of the income. That's it. I deviate from my discussion. And the cash flows. So ultimately your assets and liabilities will be able, and the equity will be able to show in the balance sheet, and your incomes and expenses including gains and losses you will be able to show in either in statement of comprehensive income if you are preparing a single statement approach. I will discuss in later videos, or you can disclose it in either profit loss account profit loss account and other comprehensive income. So if you're following a single statement approach and if you're following a double statement approach, two things is there. And for the cash flow, you are referring to the statement of cash flow. One thing remember guys, not use the word cash flow statement, it is statement of cash flows. If you want to comply, just mention it statement of cash flows, easy like that. Go ahead. Now I'll discuss it about some frequency of reporting and the period covered. Now what does the IAS 1 says regarding the frequency? How frequent you need to prepare your financial statements, how frequent you need to close your books, how frequent you need to prepare your financial statements. Under IFRS, IAS 1 specifies that at a minimum it should at least prepare the financial statement annually, at least annually. But look, there might be certain cases that you have changed your period ending dates, which may be, there are cases, I've seen cases where they're preparing for 15 months and they're saying they are compliant with the IFRS. Okay, oh my god, how you're complying with IFRS? IFRS says, when I talk about IFRS, it means IAS. Disclaimer. So when the standard says they are complying with IFRS and they are preparing financial statement for a period of 15 months, how they are complying with the IFRS? Now IFRS says at least minimum you need to prepare the financial statement, but there might be certain cases in your business you need to change your period ending date. In such a case, your financial statement may be either less than 12 months or more than 12 months. Then in such a case, IFRS is an option. If you want to prepare your financial statement either for less than 12 months or for more than 12 months, either for less than 12 months or for more than 12 months, just disclose two separate things. The first thing is why you are doing it, plus, and the fact that the financial statements are not entirely comparable. It is not comparable. And one thing I say that when you read the conceptual framework of financial statements, it specifies the foundation of how a financial statement should be. So financial statements should be comparable with the prior period, comparable with its peers. So if you want to prepare a financial statement, should be comparable, the period should be same, right? And if the periods are not same, how are you going to prepare, how are you going to compare? So these two definitions you need to mention in the financial statement. On a nutshell, primarily you need to prepare financial statement annually. If you are not preparing financial statement annually, it may be less than 12 months or more than 12 months. If it is less than or more than 12 months, you need to disclose two things. The first, why you are deviating from a 12 months standard requirements, plus you need to mention it is not comparable because you're not preparing a 12-month standards. So I've already disclosed what the financial statement should comprise of. It should comprise of a statement of financial position, statement which is called the balance sheet, statement of an income statement or in statement of comprehensive income and other comprehensive income, statement of changes in equity, statement of cash flows, and notes. What do you mean by notes? Notes are primarily certain explanations, either it may be narrative or maybe disaggregation of the details that has been given, which either it's required to disclose separately in the notes to provide much more clarifications. Note explains what there has been explained either in the financial statement